Hello, and welcome to Virtual Investor Conferences. My name is Cecilia Schombaum. On behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Rubicon Minerals. Before I introduce our speaker, a few points to note. Please submit your questions in the questions box below the slides. Once the Q&A session is ended, don't log out. You will automatically be transferred into the Rubicon booth, where you can access shareholder materials. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I am very pleased to welcome George Ogilvie, President and Chief Executive Officer of Rubicon Minerals, which trades on the OTCQX Best Market under the symbol RBYCF and on the TSX under the symbol RMX. Welcome, George.
Thank you, Cecilia. Good morning, ladies and gentlemen, and thank you for joining Rubicon Minerals today. The title of my presentation is the Phoenix Gold Project Feasibility Study, on track for delivery in the second half of 2020. This presentation actually is on our website, so there are some forward-looking statements. So I draw your attention to the cautionary language. Please feel free to review that on our website at your own discretion. First of all, with respect to COVID-19, I'm happy to report that within the company, our business has not been affected. Since March the 12th, the corporate office has been closed and the executive team has been working all remotely from home. Because we only have 30 employees on our employment, our site is quite large. So it lends itself to naturally social distancing. So on any one shift, we would have no more than 8 people reporting to work. So things are going well there. The underground drilling is proceeding well, and we've now completed all the infill drilling on the F2 Phoenix deposit, and our feasibility study is proceeding at pace. Importantly, we've asked the consultants to ensure that they have a designate in case one of the consultants who's conducting the feasibility study becomes ill and is not able to work from home. We have a backup in place who immediately can step into their shoes, and we won't lose any time on the feasibility study. A little bit about the share capital structure of the company. Today, we currently have just under 15 million Canadian dollars cash in the bank. We're fully funded through until the second quarter of 2021. And of course, the feasibility study should be out into the market in September of this year, whereafter we're intending to announce the project capital financing in the fourth quarter of this year. Currently, we have 95 million shares issued on a fully diluted basis, about 104 million. The options and warrants are currently not in the money. They have a weighted average price of around $1.37, so still significantly above today's share price of around $1.12. At that share price, the market cap of the company currently is 107 million Canadian dollars, and you'll see that we're followed by 8 analysts. We've recently increased coverage through Stifel GMP, taking up coverage of Rubicon. Target price anywhere from $2 to $3.60 Canadian. And you'll see we have a very strong institutional shareholder registry. Importantly, however, our retail component is increasing and almost 20% of our shareholder base now is retail. If we look at the high-level key performance indicators that came out of our PEA that we put out last year, we used a conservative gold price of $13.25 US dollars or 17.62 Canadian based on a 0.75 exchange rate. The IRR after tax was just over 40%. The NPV on the project as a standalone was 135 million, and there was 192 million Canadian dollars free cash flow over about 6.2 years. I'm going to show you on some of the future slides that we're going to look at how we intend to improve upon those economics at the same gold price and exchange rate without considering today's spot prices. As far as the initial capital is concerned, it was broken down from 101 million of upfront capital, which consisted of 43 million of underground development and infrastructure. 36 million of that is underground development, which I'll show you in a future slide. We plan on purchasing all our equipment up front, and we're showing that at 16.9 million. Now, there is an opportunity to look at a 4 or 5 year capital lease and spread those payments out, so all the money is not required up front. And then on the mill, we're looking at a ammonia reactor on surface, a primary crusher, a surface warehouse, a surface maintenance shop, and we'd also like to raise the tailings impoundment area dam by 2 meters in the first 18 months. So all of that goes into the $23 million you see there. We've added in an 18% contingency, giving us the 101 million. Now, importantly, over the first 20 months, which is the ramp-up period to commercial production, you can see there's a working capital requirement of 46 million. But importantly, between month 8 to month 20, we actually produce 44,500 ounces of gold. And at 1762 Canadian gold price, it gives us 75 million of revenue from gold sales. If we were to look at today's spot prices of close to 2,400 Canadian dollar an ounce gold price, that would generate an additional $30 million in revenue from gold sales. And provided everything else is equal within the feasibility study, that could minimize our capital requirements for the project financing by the corresponding amount. So that leaves us with a cash flow from operations of 29 million, pre-commercial production capital of 72 million, and when we look at our inventory adjustments, we're looking at about 81 million. So as far as mining projects are concerned, we believe that that's fair and reasonable, and we have every confidence that we can finance this project on the back of a positive, robust feasibility study late third quarter of this year. So moving on to slide number 8 and looking at the sensitivity analysis. If we look at today's gold price of just under $1,700 an ounce with the same exchange rate of 0.75, you can see the project after tax has an IRR of 92%, 371 million NPV, and close to 500 million Canadian dollars in free cash flow over 6.2 years. And we strongly believe that the feasibility study is going to see more life of mine than what we see in the PEA, which will obviously improve the economics further. If we look at the downside risk with respect to Rubicon, and you believe that the project NPV at 135 million is fair and reasonable, above and beyond that, we have 28,000 hectares of prime real estate in Red Lake, which is one of the most prestigious gold mining camps in Canada. Now, several years ago, before I joined the company, there was a strategic review process ran on the company. There were 2 bids made for the regional land package alone, and that was in a distressed situation of 20 and 25 million Canadian dollars. So today, with the company being in a much stronger position, and with Evolution Mining coming into the camp as a mid-tier 5 billion market cap Australian producer, we believe the regional land package is worth well in excess of 30 million Canadian dollars. Now, as well as the 15 million Canadian dollars cash we have in the bank, we have 690 million Canadian dollars of tax loss pools, of which approximately half of those pools could be used in further merger and acquisition activity, either with the company looking to be the acquirer or potentially a strategic looking to acquire Rubicon. So if we assigned only $20 million to the cash in the bank in the tax pools, and we added those numbers up, it would give us a valuation of 185 million. If we deduct our current liability of 12 million Canadian dollars plus a 5% PIK to Sprott Lending, which matures at the end of this calendar year, you can see you end up with about 170 million Canadian dollars as a real base case valuation for Rubicon, which is still approximately 60 million Canadian dollars more than the current market cap of the company. So we think even in a worst case scenario, there's significant upside from this level. If we also now look at the slide number 8 in the Google map, looking down on the site, you can see in the left foreground there we have the mill building. Now the mill is permitted for 1,250 metric tons per day. However, several years ago we did a bulk sample through the mill. The mill was built for 1,800 tons per day, and we actually ran that mill on several days at around 1,600 metric tons per day. We saw a 95% metallurgical recovery, and 43% of the gold came off with gravity. So the mill performs extremely well. Behind the mill, we have a 720-meter deep shaft with a full functional hoisting loading system, 10-ton skips that sit over the cages, and on a 24-hour basis, the hoist will actually lift about 3,000 metric tons of rock per day to surface. In the center of the page, you can see our tailings impoundment area there. We also have a 44 kVA electrical line right into the mine site. There's a 200-man camp, which is in good condition and is dormant today on care and maintenance. And we also have access to fresh water. And of course, we're 8 kilometers outside of Barma Town in Red Lake. And there on the bottom right-hand side of that slide, you can see that we have the $690 million of tax pools, which is a legacy from Rubicon 1.0 with all the investment that was made during the early 2000s and going through until 2015. So slide number 9 just shows us the conceptual life of mine plan that came out of the PEA. You'll see there that we have C1 cash costs of $624 an ounce, all-in sustaining costs of $882 an ounce. And you'll also notice that the average annual production is just under 80,000 ounces with a head grade reporting to the mill of 5.3 grams per ton. Now another number that I'll highlight here is the sustaining capital, which over the 5 years of initial commercial production is showing in at $154 million. We believe that there's a likelihood over the comparable period in the feasibility study that the sustaining capital actually should go down, and I'll explain that on the next slide. So on slide number 10, what you're looking at here is everything you see in purple is a sunk cost. So you see the shaft, there's 14,000 meters of lateral development within the mine. Everything you see in the light blue would be the pre-commercial production development, which is approximately 6,000 meters, and at $6,000 per meter would be 36 million Canadian dollars. That's part of that 43 million that we looked at within the capital project financing. Now, the green that you're looking at is the sustaining capital, and you'll notice that the ramp goes all the way to 1,400 meters below surface. However, within the feasibility study, we'll only be going after measured and indicated resources, which will only extend down to approximately 1,100 meters below surface. So in effect, that means that within the feasibility study, the ramp does not have to go to 1,400 level. It will only have to go to 1,100 meter level, and that means there's going to be 300 vertical meters of ramping, haulage drafts, vent raises, ore passes that will get taken out of the sustaining capital over the first 6 years within the feasibility study. And we think that's going to minimize the feasibility study's sustaining capital in that first 6 years by approximately 30 to 50 million Canadian dollars. Now, of course, if the feasibility study ends up being 7 or 8 years in duration as an initial base case, then there will be additional sustaining capital going in years 7 and 8. However, the overall economic, the benefits should improve the NPV of the project. The other point to bring out here on this slide is that the development rate is only set at 14.7 or 5 rounds per day. We believe within the feasibility study we can go a little bit faster, meaning that we can get to commercial production well before the 20 months that we're showing in the PEA. And we've also put contractor rates in there of between $5,500 and $6,500 a meter. If we were to do owner-operator crews, we suspect that we could reduce those unit costs by 10 to 15%. Moving on to slide 11, here we show the progression of the resource over the last 3 years as we've continually upgraded it on an annual basis. Today we have 811,000 ounces of M&I. I will point out that the measured category is now drilled off on an 8-meter drill density, and the indicated category is on a 18-meter average drill density. So M&I combined is on a 15-meter average drill density. So we feel confident that if we can fit stoping shapes into the resource blocks within a feasibility study and generate reserves, which Rubicon 1.0 never had, generate reserves on a 15-meter drill density, we'll feel confident that if we take the mine into commercial production, we can actually deliver on our life of mine plans. And then obviously behind that, we have inferred resource of 464,000 ounces at close to 7 grams. Now, slide number 12 just indicates the current M&I, which is represented in red and green, which goes down, as you can see there, about 900 meters below surface. This resource was cut off in September of last year, and since then we've been doing infill drilling into an inferred area, which is represented in that rectangular box. And you'll notice how that only goes down to 1,100 meters. So the assays are in now, and they've been handed off to the consultant, and they will be included in the life of mine plan over the next couple of months as we put that together. Now, the inferred resource stretches to 1,400 level. However, Rubicon 1.0 drilled as deep as 1,600 meters below surface, and we found that there was mineralization still there. It's in a non-compliant category because the drill density is greater than 80 meters, so it doesn't qualify for an inferred resource. It averages about 100 meters, but we believe strongly over time, as we drive the ramp down on ourselves, we're going to be able to do infill drilling and exploration and add to that resource. So as of last week, Friday, in actual fact, the feasibility study is now 54% complete, with approximately 50% of the monies having been spent. So we're well on track to deliver the feasibility study in September of this year. If we look at the properties that we control within Red Lake, you can see there's lots of potential synergies with Evolution Mining, who've recently acquired the Newmont assets in Red Lake. If you draw a line through the Campbell, Red Lake, and Cauchner mine, it takes you right through the McQuaig and the Slate Bay properties, which Rubicon 1.0 had drilled upon and found mineralization. Another example of synergies could be where Evolution has the gas zone, a compliant resource of 360,000 ounces at 8 grams per ton, very close to surface. Rubicon 1.0 drilled on East Bay at depth and found mineralization with the same lithology and same structure as what they see at the gas zone. So it would appear to be perhaps an extension of the gas zone through the imaginary property boundary to depth over onto Rubicon's property on the other side of the boundary. Moving away a little bit from Phoenix and looking at some close proximity targets that all sit within 2 kilometers of the shaft, the mine, and the mill infrastructure. First of all, let's consider McFinley. It was a former producing mine that was briefly in production in the early 2000s. Today it has a non-compliant resource of 67,000 ounces at 6.8 grams per ton in the ground, and historically was only drilled off a couple of hundred meters below surface. So in the first quarter of this year, we've been underground at McFinley taking chip and muck samples. We've now put together a diamond drill program, and you'll shortly be seeing the exploration results coming out in the second quarter of our efforts at McFinley. What's interesting about McFinley is that several years ago, we had a diamond drill at 685 level, drilling out to the F2 deposit, which is on the right of the slide you're currently looking at. We had some idle time on the drill. We flipped it around 180 degrees, poked out a 550 meter deep hole, went through 4 bands of mineralization, but importantly, the rock type and structures that we see there are the same as what we see 550 meters up, higher up in the package at McFinley. So now we have an opportunity where within 500 to 600 meters of a full production shaft, we have an area which is completely unexplored. And it would be our intention over time to explore there. The current goal is in the 4th quarter of this year is to put out a compliant resource on McFinley, which will hopefully show the market that in addition to have a robust, economically viable mine at Phoenix, we have significant organic growth opportunities. The same is also true with respect to the zone that you see on the right-hand side there, known as the Pen Zone. We've had a diamond drill set up on the 244 exploration drift in the month of April. There have been 2 holes drilled out to the Pen Zone. There's currently another 3 or 4 holes laid out, and those results will be coming to the market over the course of the next quarter. You can see on slide number 17 here that Rubicon 1.0 did actually drill the Pen Zone, the Carbonate, and the Island Zone from surface. The dark area you would see there would be the lake, but now we've got the ability to drill it out from underground. And we would be hoping that in early 2021, similar to McFinley, we would be able to come out with a 43-101 compliant resource on the Pen Zone, which sits approximately 500 meters away from that exploration drift, or about a kilometer away from the full production shaft and a big hungry mill sitting on surface. So I think key takeaways for Rubicon would be that I think we're a very undervalued story when compared to other advanced exploration stories. I think we bring a lot to the table. We have a very robust project with very conservative assumptions being utilized. If we start to consider the spot price of gold and exchange rate, then really the valuation goes exponential. We have significant tax loss pools, which mean that we will never pay any tax on the Phoenix project. Indeed, in the PEA, at the end of the 6.2 years of production, we still had $521 million of unused tax pools for Phoenix and or M&A activity. We believe with the 28,000 hectares of land that we have in Red Lake, which really needs to be explored, it's extremely strategic and incredibly valuable. And of course, we're in a tier 1 jurisdiction that from a socioeconomic perspective is extremely safe. So that concludes the presentation. I'm now going to switch over to looking at what sort of questions have come through. And the first one I see here is from Howie Flinker. Howie's asking, George, what is the possibility that the new hole near Peninsula indicates ore all the way from the Phoenix shaft to the satellite of the Peninsula? Well, I don't think that we're going to see mineralization all the way out from the existing shaft to the Peninsula zone. However, we do know with the repeating patterns within the camp that certainly there will be mineralization out there. Rubicon 1.0 did hit mineralization on the Pen Zone and on the Island and on the Carbonate Zone when they drilled from surface. We don't have the assay results back from the first 2 holes, but we do know that we have gone through a basalt, and typically at the Phoenix deposit, when we go through basalt, that's where we find quartz veins and sulfide mineralization, which carries the gold. So still early days, but we've definitely hit the right rock package there. We have another question here from Michael Hahn. Can you remind us of problems that beset Rubicon 1.0 and why did it not work? Well, there were significant problems. I think first and foremost, trying to take a project to commercial production on the back of 3 preliminary economic assessments. That's a big risk because you don't have reserves and therefore they're not economically viable. And the level of infill drilling just wasn't there in the past. And as we've stated, we have a feasibility study with reserves coming out at the end of this year. The infill drilling pattern is now down to 15 meters. And without getting into the technical details, all the drilling that we've completed over the last 3 years is orientated drilling, which gives us a much better geological structural model than what Rubicon 1.0 could develop. And you may remember that we proved that by putting 40,000 tons through our mill 2 years ago. 30,000 tons of that was ore. And we ended up getting a 14% positive reconciliation when compared to the resource model, 7% higher on tons, and also 6% higher on grade. So we feel confident that we've certainly mitigated some of the risks that they had, or problems that they had in the past. William Love here is saying, why do you feel you have a better understanding of the structural controls of the mineralization that Rubicon 1.0 had? Okay, well that touches on what I said about the orientated drilling. Without getting into too much technical detail, orientated drilling basically means that when you remove the core from the barrel of the drill, you know in 3-dimensional space how that core is orientated. If you think of it like an analogy, like a clock face on the wall, you would know where 12, 3, 6, and 9 o'clock are located. When the geologist gets the core to surface and he has 12 o'clock facing up on his bench, and he goes over the core and indicates where the quartz veins and the gold veins are, he can then do several things. He can measure their dip and azimuth. And when you put that into the computer and you know how the core is orientated in 3D space, you can essentially join the dots between other holes or development, and you can start to see patterns emerging. And importantly for this deposit, we saw that there was a pattern emerging where the gold veins run north-south in the same direction as the high tide basalt. They also run east-west perpendicular within the high tide basalt and northwest-southeast. And that's what allowed us to hit upon a Rydell shear model. Now we do see the basalt package being broken up. That comes from a fault system north of us, known as the East Bay Deformation Fault. And over millions of years, it's been pulling the rock packages apart. And they perform no differently than an elastic band. And when they reach their tensile breaking strength, they break and they form these boudinage lenses. But importantly, if we stay within the basalt boudinage lenses, which appear to be large enough to be mined with a bulk mining method, we can actually have an economically viable mine. And again, our bulk sample proved that in the summer of 2018. I have a question here from Glenn Galata. What level of exploration spending is being planned over the remaining land holdings? Well, we touched on that. We've now stopped the drilling at Phoenix. We feel that we're going to have converted enough inferred material into the M&I to allow us to complete our feasibility study. And between April now and the end of the year, our efforts will be now focused in on McFinley and the Penn Zone. Right now, phase 1, there's not a significant amount of drilling on those 2 areas. I believe it's going to be 5,000 to 6,000 meters in total. However, depending upon the results, we may upscale that program as we go forward into the second half of the year. But we are confident that we will see mineralization at McFinley, and we have high hopes that we'll see mineralization also out at the Penn Zone. We've got a question here from Emil, just quickly. George, can you speak to the rebranding of the company? So the company has initiated a rebranding. Our management information circular that goes to shareholders this month will propose a new corporation name for the company and a new project name. We now feel it's time to let go of the shackles of Rubicon 1.0, as we now have significantly de-risked this project over the last 3.5 years. It's time to let go of the shackles of the past and move on with a new corporate name, because it is very much a different company today. And with that, that concludes the presentation. Thank you ever so much for your time.